Welcome to today's edition of Etienne's Place. I'm David Etienne, and I'm here to spend a couple of minutes with you. Now, today we're going to focus on a topic that can be very complex, but as usual, we want to look at just some of the basic or the essential components of this topic. And I know you're tired to hear me say it, but I cannot help myself but to repeat and repeat and repeat, as some would say, repeat again, is that when we share these tidbits, they are meant to, as it were, prick your curiosity, stir your curiosity into seeking additional information. Because most of these topics can be much more complex than presented here. But the purpose here is not to have an academic lecture, so to speak, but to expose our clients to some of the things that may impact them. And so we want to give you that amount of information that will help you to understand the basics. And if you need more information, then as I keep saying, speak to your professionals. Okay, this evening we want to speak a little bit about selling your home. Questions have been asked about the implications of selling my house, selling my home, making a profit on that sale, the tax implication of that profit, etc., etc. So before we jump into the actual selling of your home, let's just spend a couple of minutes speaking on the concept of capital gains in a general sense. Whenever or whatever asset you may own, be it a car, a house, some investments in stocks and bonds, you name it. Whenever you own an asset, you have something of value, and you decide to sell it, then that transaction is going to result into a net position where if what you receive for selling this asset is greater than the cost to you of that asset, then you would have made a capital gain. Now, I mentioned the cost to you. Now, even the cost to you is not quite as simple as it sounds, because you may hear people talk about the cost of purchase different from the basis of the property, because you have various components that goes into add on to the cost, or minus whatever to derive your basis. So really, the profit or loss is derived from a comparison between the sales proceeds, the amount of money you got for selling this asset, and the basis. But for purpose of this discussion, we're assuming that that basis is your cost. Just to simplify it, to indicate that the difference between the value to you, the cost, the value that you're holding, and the amount of money you receive when you dispose of this asset. Then, if the amount of money received or the sales price is higher than the cost price, then obviously you would have made a gain. Such a gain is referred to as a capital gain. Good. Once you have a capital gain coming out of a transaction, then you're going to be faced with capital gains tax. Because capital gains is, you can see it as the profit that you make on the disposal of an asset, right? Whereas normal operating profit is from you trading, buying and selling in a normal business. But capital gains will be subjected to capital gains tax. Two very important concepts for us to look at. The concept of the short term versus the long term. In dealing with assets and disposal of assets and capital gains, we always need to ascertain whether or not this capital gain is going to be treated as a long-term capital gain or a short-term capital gain. Of course, if it is a short-term, if it is a case where you have held this asset, this car, this investment, this equipment, whatever, this house, if you have held this asset for less than a year before you sell it, then whatever gain you have, whatever capital gains you make, will be regarded as a short-term capital gains. So it means, therefore, that once I have this property, this asset, and I've held it for less than a year, okay, less than a year before selling it, then any gain that I make on this sale, any capital gains that I make on this sale is referred to as a short-term capital gain. Now, a short-term capital gain is taxed at a higher rate than a long-term capital gain, which we'll come to shortly, because short-term capital gains are taxed just as your ordinary income, at the same rate as your ordinary income. So they are likely to be taxed at a higher rate than long-term. Wherever you have a short-term capital gain, you're likely to have a higher rate than a long-term. So let us quickly switch over to the long-term. It follows. If I'm saying that your short-term capital gains is where you have had this asset for less than a year before you sell it, then it stands to reason that if you have had this asset, this equipment for 1 or more years, 1 year or more before selling it, then you may have it for 2, 3, 4, then you're gone into the long term. Okay, you've gone into the long term, and as such, you would have earned a long term capital gain. And so the tax applicable to that, or the tax rate rather applicable to that, would be one coming out of what we call the long-term capital gains tax rates. Okay, these will be lower. These will be lower, as I indicated. So your short-term capital gains tax rates will be higher because it is just as your normal ordinary income tax rates. Whereas if you have a long-term capital gains, mean that you have held this equipment, this asset for more than a year or more prior to disposal, prior to sale, then it will be classified as a long-term capital gain, and it will be taxed at a lower rate than your ordinary income. Good. Let's start. We'll get those concepts in and out of the way. So let us look now at the home. So yes, you have your home, and as a matter of fact, I'll back up a bit. Let's not call it a home for now. Let's call it a house. You have a house, and you decide, I want to sell this house. Whether it be short term or long term, no problem. We have already discussed the difference. So you have this house, and you intend to sell the house. So based on our previous discussion or explanation, right away you will be able to determine whether or not the gain you make on this sale of house is going to be a long-term capital gain or a short-term capital gain. And then you would go the next step to decide, okay, if it's a long-term capital gain, what would be the applicable tax rate? If it's a short-term capital gain, what would be the applicable tax rate? However, whereas I spoke about selling a house, I want to narrow it down now. The house that you're selling, it can either be your main dwelling house, which now becomes your home. See, so I'm transitioning from just selling a house, and I'm getting a little more specific by saying that this house that you're selling, it can either be a house that you live in, so it is your dwelling home, it is your home, your family home, whatever. Or it can be a house that you own, but you have not lived in it or you do not live in it, and therefore it could be just another investment property. You may have tenants in it, whatever you do. So if you notice, I started by talking about selling a house, but then I want you to recognize that if that house happens to be your primary residence, your home, then the treatment is going to be different than if that house was just there for investment purposes. Good. So then let us focus on when that house is your home, your primary residence. That's good news because the good news is that once you're selling this house and it is your primary residence, then you can get an exemption. Call it a capital gains tax exemption from the tax on the gain once it is your dwelling house, your primary residence. So of course, like all everything in life, but specifically in the tax code, there are certain conditions under which you can qualify for this benefit of getting an exemption. And so one, we said you must have owned, listen carefully, you must have owned the home for at least 2 years of the 5 years leading up to the sale. You must have lived in this house as your primary residence for at least 2 years out of the 5 years leading to the sale. So, for example, if it is now 2020 and you intend to sell this year, then 5 years prior would take us to about 2015, thereabout. Okay? 2015 and 5 is 2020. So what we're saying is that, or what the law is saying is that you should have been living in this house for at least two of those 5 years between 2015 to 2020 to qualify, so that when you're selling 2020, you would have been living for at least 2 years out of the prior 5 years, 5 years prior to the sales date. That's one condition. Good. So that is the ownership condition. Ownership, you must have owned it. Then now you must have also, it must have also been your primary residence, right? For at least 2 years of that 5 years. So you see, there's an ownership condition or requirement, ownership, and there's also a primary residence requirement. Okay, ownership, primary residence. And the third condition is that naturally you don't expect to be getting this exemption year over year after year after year. So the third condition is that you only qualify for the exemption this time around if you had not received some exclusion on some property over 2 years before the current sale. Okay? The third condition is that you must not have benefited from this said exclusion that you're now seeking, okay, over the 2 years, over the last 2 years preceding the sale. So back to our date line, it is now 2020. We're selling the property this year. We must not have received an exemption for at least 2 years prior to the sale in 2020. So there should not have been any exemption received or exclusion received in 2019, 2018. Okay? Must not have received such a benefit, such an exclusion for any other property that you may have sold over the 2 years preceding the current sale. So there you have it. Yes, you will make a capital gain on the sale of your primary residence. Yes, it could be a short-term gain or it could be a long-term gain. Yes, there are different tax implications given whether it is short or long. But once it is your primary residence and you satisfy all these three conditions, because you are due to receive this exclusion, then it does not really matter to you whether it's a long term or short term, because at this point you are protected. Okay, you are insulated from from these tax, irrespective of whether or not it's short-term or long-term tax rates we're talking about. So that is that's what you benefit from as a homeowner. And let me say that remember now, the capital gains tax is naturally on the gain. And the rule also says that whereas you're entitled and you're due to receive this exclusion, the exclusion is not limitless. So, in other words, if you have a $2 million house and you sell it for 10 million, so it means therefore you'd have okay, let me not exaggerate. Okay, so you have a $2 million house, you sell it for $5 million. Right away, we're looking at, easy calculation, $3 million gain. You cannot get exclusion. You cannot get exclusion from all the tax on that 3 million. No. The rule is saying if your filing status is single, then you are allowed up to $250,000 gain. Now, careful, not $250,000 as if it were the sales proceeds. No, it is always a difference between the cost, the basis, and the selling price of the property. That the difference between those two numbers will give you the gain. And we're saying that if your filing status is single, then you will be given exclusion from any tax on this gain up to $250,000. So if your gain was more than that, only 250 will be excluded from the capital gains tax. You'll have to pay tax on the excess. And if your filing status is married filing joint, then of course that is doubled, and so $500,000, $500,000 is the kind of capital gains tax exclusion that you'll be entitled to under those conditions. Okay, so that is it for selling a house where that house is your home. On the other hand, you could be selling this house, but it is not your home. It's not your primary residence. This is not where you live. You may be a man who owns 2, 3, 4 houses. Okay, and so if you're selling one of those that's not your primary residence, then the rule of the game changes somewhat. It's a clear investment property, so to speak. So if you sell and you find that you make a gain, then yes, there's going to be some amount of tax to pay. Now, of course, the whole concept of is it a short-term gain? Is it a long-term gain? Which is predicated on the length of time between when you acquired and when you dispose. That will determine whether it's short-term or long-term, as we said before. Then now you'll be required to pay your capital gains tax on that profit as an investment property. So the question is asked, so there's nothing if the house I'm selling is really investment property only for those guys who are selling their primary residence? And I'm saying no. There's a provision. The tax code has a certain section in it, and that section is referred to as section 1031, 1031. It's just a section in the tax code, and it makes a special provision. What is it saying is that if you're selling one investment, if you're disposing of one investment property and you're acquiring a similar type of investment property, as a matter of fact, it is referred to as trading in of like kind property, like kind. For example, let us say that I live in state X, and by virtue of my business, I have a large warehouse, and I'm transitioning. I'm moving out of state. I'm going to another state to set up business. I'm closing down shop here, so I'm selling everything, and I'm actually getting rid of this warehouse that I have here in whatever state I am, and I'm moving to another state where I will need another warehouse because I'm going to continue the same line of business. I'm just changing state. Now, in this case, I'm saying if I dispose of my warehouse in this state, get the funds, I may have made a whopping gain on the funds, but then, well, I shouldn't put it that way. I shouldn't put it that way. I'm talking about I'm disposing of warehouse here. I'm going to acquire warehouse there. So it's actually like kind. That's what we refer to. Like kind property, a trading of like kind property. So in other words, I would not get this exemption, so to speak, if I was getting rid of warehouse space and going into a retail outlet elsewhere. No, that's not like kind. I would have to, man up and pay the capital gains tax on the sale of the warehouse. But where I have like kind properties, getting out of this, getting into that, but they are similar type. As I said, the warehouse is a good example. Then that section in the tax code, section 1031, gives me that relief, so to speak, and so I'll be able to avoid paying the capital gains tax on such a transaction. Okay, so that's basically the case. So that's about it, because I know most of my clients, are contemplating, questions have been asked, contemplating selling home, selling their home, and what's the implication, etc., etc. So that in a nutshell, those are the rules of the game. Those are the, so be aware. Those are the rules. What I've just explained is not all the ends, all the ends, the ins and outs, so to speak, of the topic. There are more to. So once you contemplate home sale, then yes, please consult your professional and thing, and get more detailed information as to the ramifications of your decisions, the tax implications, etc., etc., etc. Okay, great. Well, once again, David Etienne, my company is Etienne Business Solution. This place is Etienne's place, and I'm happy that you decide to hang out with me one more day. So remember, subscribe to our YouTube channel, Etienne's Place. There are a ton load, well, maybe not quite a ton as yet, but I'm getting there. I'm getting there. It's quite a bit, less than a ton, but quite a bit of information that I know that you will find to be very informative and that will help you in your business journey. Before I go, let me quickly thank those friends, clients, neighbors, strangers who came out in January. It was January 23, I think it was, to my winter seminar, which was entitled Cash Flow Management for the Cash Strapped Manager. We really had a good time. I think we learned quite a bit. I enjoyed the interaction, and I hope that the information that was disseminated, you will take it, you will apply it, and you will use it to become better businessmen and businesswomen going forward. So this was my first appearance for the new year. I think. No, maybe not. No, not true. I appeared in January. But anyhow, wishing you all the best. And yes, we're right in the tax season, very hectic season. But it is what it is. We're happy for it. We look forward to meeting our clients. And I encourage you to come over. Don't wait until it's almost April 10th, and then you get in a panic, etc. You have time to organize yourself. So get yourself together, come on time, get your thing done. Or if you're not going to make that April 15 deadline, then do not procrastinate. Move quickly to asking your tax preparer to file an extension. And I cannot help but remind you, an extension, an application for an extension is an application for an extension of time to file, not an application for an extension of time to pay. So if you got a filing, an extension, and when you do file your taxes, you're getting a refund, you're good to go. But if you file for an extension and when you ultimately file your taxes, you're owing, then definitely there will still be a penalty, meaning that you owe the tax from the deadline of April 15 up to the point where you file those taxes and pay. Right. So remember now, a lot of persons get confused with this. Okay, an application for an extension is an application for an extension to file, not an application for an extension of time to pay. Note. But anyhow, have a good evening, and I look forward to seeing you